Hello and welcome to another edition of the Friday Interest Rate Update. Interest rates dropped below 7% for the first time since February 13th, and this week was all about jobs with the release of the ADP jobs report on Wednesday and the BLS, Bureau of Labor Statistics jobs report today. So I'm going to dive into the jobs data a little bit as it is incredibly important for the direction of interest rates and one of the main reasons why interest rates are where they are right now. So it's been very, very difficult to fully believe the BLS report, which is the Fed's favorite benchmark for jobs. We've talked about it many times. There has been huge disparity between the ADP report and the BLS reports. So let's talk a little bit about the BLS report. It is a lot more nuanced, where they can actually adjust numbers at their discretion with just a stroke of a brush, as the data is based primarily on modeling and imputed data. And so they just make adjustments really when they see fit. So sure enough, the BLS report today showed 167,000 jobs, downward revisions from the previous two reports in December and January, where they reported jobs this month at 275,000. Will that be adjusted next time? We'll have to wait and see. But why is this significant? Wall Street typically reacts to the headline numbers. They know that the Fed relies on these numbers to direct economic policy by raising or lowering the Fed funds rate. It's incredible, but the BLS job numbers have been revised downward virtually every single month for the last year and a half. So, however, Wall Street has to rely on this data. So to them, they trade mortgage-backed securities based on the data available at the time. So the headline numbers really are what they're trading on. So the BLS reports have typically been coming out, making the job numbers look great and the economy humming along, when in fact, it is almost always revised downward. And Wall Street just has a difficult time interpreting the data. When you have uncertainty, it's hard to really make those financial decisions. The ADP report, on the other hand, is way more solid data and real, but it does not count jobs created by the government. So there's some interpretation that they have to make. So this report has been steady, showing modest growth in jobs. And there's always been up and down in those. So a strong job market concerns Wall Street, as it typically leads to higher inflation. Conversely, a weak job market means employers don't typically have to pay as much, which helps reduce wage inflation. All this said, I think the Fed is starting to recognize some weakness and seeing some cracks in the economy. Most of the jobs created are part-time jobs. We're losing full-time jobs. Credit card debt is well over $1 trillion, and consumers are getting maxed out. The Fed cannot wait too long to start adjusting the Fed funds rate downward, or the economy could fall into a recession. So in my opinion, there is still a window, but it's getting smaller and smaller for home buyers to take advantage of having less buyers to compete with in the market right now. So when rates moved lower, when rates moved over 7% in February, there was a definite slowdown in buyer activity. We also polled our Las Vegas pitch audience, and anecdotally, they confirmed a slowdown of buyer activity as well. So now, with rates dropping back into the sixes again, in the high sixes, we anticipate buyers to start coming back. That data is going to go out into the media soon. And when rates fall further, we will definitely see more buyer activity. With the limited inventory, we could see multiple offers again, particularly on well-presented listings. So keep your buyers out there looking. I'm always available on weekends to help get your buyers pre-approved and into their dream home. I hope you have a fun weekend, and we'll see you next week on the Friday Interest Rate Update. Gaylord out. Bye, everybody.